Phil expanded also. Shalom, and thank you for joining us. My name is Josh Sussman from Nefesh B'Nefesh. We will be starting in about 4 or 5 minutes. Thank you for being on time, but we do want to let some of the less prompt people join us. So we will be with you in about 4 minutes. Thank you. Shalom, and thank you for joining us. My name is Josh Sussman from the Marketing and Events team at Nefesh B'Nefesh. We are very, very happy to have you with us this afternoon, evening in Israel. I am honored to have with us Philip Stein, President and CEO of Philip Stein & Associates, Fred Kahn, also of Philip Stein and Associates, he's a partner. R.O. Swinken, the co-founder and CFO of Route 38, and Doron Cohen, who's a partner at Ravet and Ravid, an Israeli tax accounting firm. We will be sharing this presentation this evening. Please note everything is being recorded. We will share with you both the recording and the presentation itself, along with all contact information and any resources mentioned in this presentation in the next 24 to 48 hours, once we are able to slightly edit the recording. And so you should be relaxed and able to listen and pay attention to what's going on and not feel like you have to write down and take notes on every little detail that's coming up. If you do have questions, please put those questions in the Q&A, not in the chat. It's much easier for us to monitor the Q&A section than it is the chat. Thank you. Phil will be moderating this session, and I will pass over to Phil to start with. Thank you.
Hi. Thank you, Josh, and thanks to Nefesh for allowing us to participate in such what we think is such an important event. Before I introduce the speakers and the format, I want to let you all, just as Josh said, to relax. It's all recorded. You don't have to worry about taking notes. But let me take you through a time tunnel for a few moments. If you were planning on making Aliyah 40 years ago, as I was, you would have encountered the following realities. You probably would not have had a telephone. Mail to the US took several months. Fax machines did not exist. There was no FedEx to Israel. There was no internet. There were no cell phones. And one would need a wheelbarrow of asimonim, which were phone tokens, to have a meaningful phone call back to the US. Let's fast forward now to today, 2020. And if I was to have then described cell phones, internet, video conferencing, overnight FedEx, I would have either been called a futurist or a science fiction writer. But that is what the reality we live in today, which allows people like you to live in Israel and work in the US. The COVID-19 pandemic has only proven that telecommuting works and is growing more and more popular. We have an outstanding program today with 3 experts in their fields. My partner, Fred Kahn, who will discuss US tax aspects of telecommuting. My colleague, Doron Cohen, Israeli CPA, leader in his field in Israeli taxation, looking at the Israeli side of taxation with regard to people who telecommute and our new immigrants. And Boris Swinken, who has the owner, CEO of Route 38, which is a personal service corporation. He'll explain to you, also known as a PEO, and has just a wonderful product and company that can service people like you. So the format we're going to use, we're not going to put up a lot of slides with all kinds of laws. We decided to tell 2 stories about 2 people who we think you can relate to, and each of our speakers will go through those narratives, touching on points that we think are relevant to you. We'll also be taking questions at the end, so submit through the Q&A, as Josh said, not through the chat, and hopefully we can get to your questions. Again, this program is recorded. Contact information will be provided. The slides are available, and without further ado, I'll start with our first narrative. David has been working for Avalon Associates for the last 7 years. He has been in charge of cybersecurity for all of Avalon's locations, which are located on the eastern seaboard of the United States. Since mid-March, David has been working exclusively from home in Tenafly, New Jersey, due to the COVID-19 pandemic. His employer recently decided that their offices would not reopen until June 2021. David turned to his employer and requested to work remotely permanently, and informed him that he and his family were relocating to Israel this September 2020. David's employer agreed to the new work arrangement, but required David to become self-employed and cease to be an employee of the organization. So what we're going to cover in this case study will be, what does David need to do in 2020? How will David receive his monthly payment and bring those funds to Israel? Where does David pay his tax? What taxes will David be subject to? And finally, what happens if David travels back periodically to work in the U.S.? So if you can remember that story, which Fred and all our speakers will go through, I will now turn it over to my partner, Fred Kahn, and we'll talk what we're calling Case Study David. Thank you.
Thank you, Philip. Good morning to everyone in America. Good afternoon to everyone in Israel. As you know, September 2020 is coming fast, so David needs to really get ready for his tax plan. He's got 2 days until September starts. When we look at David's story, the first thing to focus on is really how Israel is going to view David in terms of taxation. Once we can, and Doron Cohen, my colleague, will talk more about that. But the starting point is really going to be how Israel will view it. And from there, we're going to move over to the U.S. taxation of his income. One of the unique things besides the 10-year holiday for Israeli taxation that a lot of people do know about is that Israel has an option called something called the Shnat Histaglut, which is during the first year that you move here, if you're there less than 180 days, and again, Doron can explain more of this, you have the ability to make an election to not be an Israeli tax resident on that portion of the year. So David does have at his disposal the ability to make such an election, which would basically say he's not an Israeli tax resident for September 2020 through December 31st, 2020, because he'll be there less than 180 days. Now, there is some tax planning that can be done for that because the U.S. has something special called the foreign earned income exclusion, which would allow him possibly to exclude some of his earnings for U.S. purposes, while Israel might look at some of that as, hey, we just made an election that I'm not a tax resident, so you might find a special sweet spot for David in terms of September through December 2020. But talking long term for David, the real focus, as I said, is to come and allocate between Israel and the U.S. to understand, is he commuting? How many days is he commuting to the United States? And based on that, to come up with a formula with Israel, how much tax he should pay in Israel versus how much tax he should pay on the United States on his earnings. Now, really to start, his employer will pay him on something called a Form 1099, and they will assumably pay him in the United States as a self-employed contractor. That being said, he has to get to an opinion with Israel, and Doron could help him to get to an opinion with Israel in terms of how much he should pay Israel for earnings that he earned while in Israel versus in the United States, because that will determine the first bite. Will Israel get the first bite or the U.S.? If we take a very simple example and you say that, David's salary is $100,000, so you say, okay, let's split it. Maybe he's in Israel 80% of the time, and you want to allocate 80% of the income to Israel and 20% to the U.S., depending, or he might not go at all to the United States because at the moment, the situation. So you need to come up with some formula as to how to split the income. And once you do that, you'll pay Israeli tax first on the income that you allocate to Israel, and you'll pay U.S. tax first to the income that you're allocating to the United States. Now, in the first 10 years, that which you pay U.S. tax on, you don't have to worry about paying Israeli tax on, but vice versa, meaning what you pay tax in Israel on, you do get a credit in the United States, but it is reported to the United States because the United States will, and they always do, tax you on your worldwide income. However, they give you a credit for Israeli taxes paid. Now, that being said, it's important to differentiate between income tax and Social Security, which in Israel, that's called Bituach Leumi. The tax treaty says that if you earn income and you pay tax in Israel, then U.S. will give you a credit. However, the U.S. and Israel do not have something called a totalization agreement. Namely, the Social Security and Bituach Leumi never came into an arrangement that if you pay Bituach Leumi, that you get a credit in the U.S. for Social Security. So that means that on the entire, in my case, $100,000 that David earns, he will have to pay U.S. Social Security self-employment tax on those earnings. That's about 15% that he'll have to pay in the United States. And in addition, he'll have to pay in Israel Bituach Leumi on those earnings that are sourced to Israel. So for certain amounts of those earnings, he could be paying, let's say, 30% just in Social Security / Bituach Leumi above and beyond the income tax on that. So that can become quite significant. Now, later on, I'm setting up my colleague Baruch Swinkin, who has really developed a unique solution to this issue. But for someone that's not doing such solution, it is important to keep in mind that you're going to pay Social Security tax and Bituach Leumi on earnings. And in my opinion, it's important to understand that your employer, now that he switched you over from being an employee to being self-employed to being a contractor, is actually saving his portion of contribution on your Social Security. So what you just realized that he's now saving, let's say, 7-8% of what he was normally contributing towards your Social Security by making you a self-employed contractor, because as a self-employed contractor, you're paying the full amount of self-employment tax. You're paying essentially both halves of Social Security on the entire earnings. So it's important to keep that in mind. One other point about Social Security versus Bituach Leumi is that a lot of our colleagues ask us, with United States Social Security, the more you put into Social Security, the more you get out when you collect Social Security. So if you've paid in 40 quarters or 10 years of Social Security, then when you reach retirement age, you'll be collecting Social Security. So the more you pay in as a self-employed contractor in Israel, the more you're contributing to that nest egg that you'll be collecting from when you reach retirement age. Israel's Bituach Leumi doesn't necessarily correlate that which you've put in versus that which you'll get back as when you take something called Kitzbat Zikna or elderly, when you get your Social Security benefits in Israel. So people do have a favorite to sometimes pay into U.S. Social Security because they view that as something that the more they put in, the more they'll get out. And one last thing about Social Security and Bituach Leumi, when you actually do collect it, if you've made Aliyah, it is tax-free when you collect it. So that's another nice benefit. Another benefit that David will be receiving here is that now that he's made Aliyah, let's say he made Aliyah from New Jersey in this case, he was living in Tenafly, while when he was in Tenafly, he was paying New Jersey state tax. Once he moves to Israel, he will be saving state tax, New Jersey tax, on the earnings that he's doing in Israel. So even though he's paying the extra, maybe Bituach Leumi or Social Security, he is saving the New Jersey state tax, which can be quite a significant savings on that end. The last area I wanted to really focus on is just in terms of his travel. It's important to take note of, there are different opinions in terms of can I deduct certain travel expenses when I go to the U.S.? Is that considered a commute or not? And generally speaking, what type of expenses are deductible, because you'll be self-employed and you can deduct expenses. So it's just important to keep in mind, what expenses do you have? What expenses are you taking? What's deductible, what's not deductible, and what are you taking as a deduction in Israel versus the United States? So really in summary, just to go through the questions, make sure I've captured everything. The focus is really to take a position, and Doron will go into this more in detail in terms of how am I reporting this income in Israel. Once I understand what I'm reporting and how I'm paying it in Israel, then I can go over to the United States and say, okay, give me a credit for the Israeli taxes paid that are for Israel sourced income. Then I'll pay US tax on US source income. And then generally speaking, possibly paying payments to the United States on Social Security and in Israel on Bituach Leumi because of the lack of treaty on those earnings. There is savings on state tax. And it's important just to keep in mind, generally speaking, what's my allocation? Is it a days-based allocation? Is it based on how much am I really contributing to the business when I'm in the United States versus Israel? And keeping track of opportunities to, as it changes, how much time am I really in Israel versus the US, to make sure that both taxing authorities are getting the proper amounts. And most importantly, you're paying the proper authority first, and therefore each one is happy and gives you the appropriate credits. So with that in mind, I'll really turn it to Doron to now discuss some of the Israeli ramifications of David's life, and then I think after that, Baruch will discuss the unique aspect that he brings, especially when it comes to Social Security and Bituach Leumi.
So I said that there is two opinions. One said that even though you are conducting your business or your services to your employer from Israel, then you don't have to pay taxes in Israel during the 10 years period, because your employer or your business is located outside of Israel. This is a very extreme approach, and I think it's right in certain cases. But now I just want to focus on the conservative approach, saying that if you are conducting your business from Israel, you have to pay the tax in Israel. But if you spend some time outside of Israel, you don't have to pay tax in Israel. So you have to allocate your income based on the days you spent in Israel and outside of Israel. So I assume that if David is just he can come to Israel and conduct his business from Israel to his then he needs to register for the tax to register with the tax authority. What do you mean register? You have to open a tax file with the Israeli tax authority, also with the VAT. VAT means that you have to pay 17% VAT on every service you provide to Israeli client. However, since David provided his services to a foreign client, he still needs to register for VAT, for VAT, but the invoice issues will be subject to zero VAT. That means he doesn't really need to pay VAT, but he needs to register for VAT authority. In addition, he needs to register for Social Security, and as self-employed, he needs to pay 17% tax to Social Security. Third of it is deductible from his self-employment income. Also, he need to pay health insurance, which is part of the 17%, and it's not deductible in Israel. About the Shnat Istaglut, as Fred mentioned, during that year, it's 12 months of Shnat Istaglut. The person is not considered an Israeli resident, so every income he received from foreign sources will not be taxable in Israel. After 1 year, all the income he received from foreign sources, in case he produced the income in Israel, will be taxed in Israel. And we can take from that income certain deductions. What are the deductions that can be taken? Of course, vehicle deduction. There is vehicle, all the car expenses, up to 45% of all the vehicle expenses, including the depreciation of the cost of the vehicle. There is office supply. There are other things that are related to his business that can be deducted from his income. After all the deduction, the taxable income is subject to tax from 10% up to 50%. Why is 50%? The maximum ban in Israel, the maximum bracket is 47, but if someone has income that exceeds 650,000 shekel a year, it's about more or less $180,000 a year, then he had to pay another 3% of tax to Israel. However, Oleh Hadash is entitled to extended called credit point, which gives him more tax saving for the third year following the day of he became Oleh Hadash. I think I covered everything, no, Fred?
Mm-hmm.
Yes, that was excellent, Doron. I think we'll now hand it over to Baruch.
Yeah.
And then we'll do case study 2 after Baruch takes care of David, okay?
Okay.
Thank you very much. First of all, I want to thank everybody. It's an honor to be here. Thank you to Nefesh for Nefesh. It's really an honor to be presenting with Phil and Fred, who are really the industry leaders here in Israel for US CPAs, as well as Daron, who is at the top of his profession. So thank you very much. There is in the slideshow that Phil is going through now, there is a glossary here of some of the payroll terms that you may either have heard or we may be using. We may not use them, but it's important to note some of these terms. We're not going to go through them in the presentation, but they will be given out. All the materials will be given out to everybody afterwards. They really are some of the most important terms that you'll be hearing when you are entering the employment arena here in Israel. And I think it's important for everyone to have a general idea of what they are, what some of those terms are. Again, so after the presentation's over, when you get these materials, please feel free to go through them and to familiarize yourself with some of these terms. As Phil mentioned before, I started a company a number of years ago called Route 38 Professional Services Ltd. In America, it's referred to as a PEO, which is a professional employment organization. In Israel, it's colloquially termed as either a manpower company or a payroll company, although it's really neither. And what we do is provide a solution for people who are like yourself, are interested in telecommuting and have heard the presentations from Fred and Daron. They were, terrific presentations, which really covered all the basics. There's a lot of material there and a lot of things to be concerned about and to take care of. And what we do is try to take all of that off your shoulders and take care of it for you. The single biggest challenge that Americans have when they make Aliyah, specifically, this doesn't necessarily apply to Canadians or to people from the UK or any other English-speaking countries, is the Social Security issue that Fred mentioned, where American citizen is going to have to pay as a 1099, opening up a tik atzma'i over here, an independent contractor file. They're going to have to pay 15% tax in the US. The best way to get around that is not to be an independent contractor, is to be an employee. And unless you're being hired by an Israeli company, that can be challenging. There is an industry here in Israel of companies such as ours that will actually take over your contract. If you're going to be a 1099, you're going to be a contractor anyway, you should have a contract with your either ex-employer or whoever your clients are. The PEO will take over that contract and actually hire you as an employee. That accomplishes a number of things. It accomplishes, first of all, that as I said, you're an employee, you no longer have to pay the 15% tax. You will get at the end of the year what is called a Tofes 106, a Form 106, which is roughly the equivalent of a US W-2. When you file with Phil and Fred, when you file your US tax returns in 2021 or 2022, whenever that's going to be, you're going to file this Tofes 106 with this Form 106 with your US tax return, with your foreign income return, and you will get off the hook for that 15%, making life very easy for you. Another wonderful benefit of being an employee is that if you are an employee in Israel and you do not have any other reportable income, this is your only source of income, you do not have to file an annual tax return. And therefore, all of the things that we've discussed and all of the issues that we have over here, you do not have to be, you should be aware of. You should always be informed and educated about them. But as an employee, the company that your employer should be withholding all of your income tax requirements, all of your Bituach Leumi requirements. You do have pension requirements that you do also have as an independent contractor. Your employer will take care of all those for you, withhold and file and pay on your behalf, and you are able to really focus on your work and focus on what you do best and not have to worry about the accounting side of it at all. Again, it is very important to be informed about all these issues and to understand them, because when you are discussing them, either with an accountant or with a professional employment organization, you do have to be aware and make sure that the people you're dealing with are knowledgeable themselves. There are many companies in the country who are dealing with this type of issue. It is very important to be informed, to make sure that, to do your research and to make sure that you know that the company you're dealing with is doing everything really on the up and up. As I said, there are a lot of companies doing this, Many of them do try to take some type of shortcut to make it a little cheaper for you. It is a very, very complicated arena, and you do need to make sure that you're dealing with professionals who really understand all the aspects of both employment here in Israel, the tax issues, the labor law issues, as well as the issues of taxation in the US. In this particular case, David really is a slam dunk to become part of a PEO, to become part of one of these companies, because he's working as a 1099. He's going to have to pay 15% if he opens up an independent contractor tax file over here. And by signing a contract with Route 38 or with any other PEO, he's going to take this entire burden off his shoulders. We will take care of all of his tax issues over here. He still has to file in the US. You always have to file in the US, but he will have nothing else to really worry about. The only downside is that he has to make a couple things. First of all, his client, his employer, has to be willing to sign such a contract. Sometimes end user clients are a little bit concerned. They don't know who the contractor is in the US. They don't know who they're dealing with in Israel. They don't know who they're dealing with. They know David very well. David is a great worker for them, but they have no idea who Baruch Swinken is or anybody else here is in Israel. And sometimes those companies are a little bit reluctant to sign such a thing, and that's something you have to be, maybe prepare them for. As well as Fred mentioned a little bit about expenses, and we'll get into this a little bit more in the next case study. If David, who is working as in cybersecurity, probably has very little overhead and therefore doesn't have too many expenses to worry about. In a case where a person does have significant overhead, working through a PEO could be a little more challenging because you will have less opportunity to deduct some of those expenses off of your taxable base. So for David, as we said, I think he's pretty much really a perfect candidate to enter into such agreement. Doron did mention there is an aggressive stance whereby for the first 10 years you may be able to say that that this is foreign earned income. But for anyone who's not willing to take such an aggressive stance, the PEO option could be a huge help for them, help them transition easily into their life in Israel, and really slide right into doing the same things they're doing before and have the PEO take care of everything for them.
Thank you. Thank you very much for that insightful presentation. We'll now move on to our second case, which we're calling our Ola. His name is Miriam. Miriam has worked for many years as an attorney for a New York-based law firm. She and her family have lived in Prospect Park in Brooklyn, from where Miriam had been commuting to the law firm's offices in Manhattan. Miriam has decided to fulfill a lifelong dream and make Aliyah in January 2021. Her law firm asked her to set up an LLC, and per advice from Israeli counsel, she also decided to open an Israeli professional corporation, which is known as an LTD. Miriam wishes to hire an administrative assistant in Israel who will be an employee of the Israeli entity. Initially, she will work out of the home she is renting in Israel. In this case study, we hope to cover what steps Miriam needs to take in 2021, what expenses can Miriam deduct, what taxes does Miriam and her Israeli company need to pay, how will Miriam determine how much money to bring into her Israeli LTD, and which entity will her law firm pay to. So I once again turn over to my partner, Fred Kahn, who will walk us through this very interesting case study, which we've seen this many, many times in our practice. Thank you, Fred.
Sure. Thank you, Philip. As I think he knows, Miriam actually is my daughter's name also, so this case study has a special place in my heart. As I said in the last case, though, what's important to do always is to allocate, to understand, okay, where do I start out vis-a-vis Israel? One important difference to note between the first case of David versus Miriam is that David has the opportunity to do something that's not his stadlut because he comes in September. Miriam, because she comes in January of 2021, is not going to have that option because she'll be there more than 180 days, so she won't have that option. So her Israeli life will be different, and Doron, I'm sure we'll get into this more. Also, she is opening up an Israeli corporation, So she is like, knocking on the tax authorities' doors in Israel and saying, here I am. So it certainly is a very different scenario. As Baruch said, story number one also is a perfect Route 38 to get paid through here. In this case, she already is saying that she has an Israeli company that's going to give her some sort of salary. She's already set up some sort of shop in Israel. But getting back, as we did to David, one of the most important things to do is to come up with some sort of formula, how we want to allocate her earnings in terms of the US and Israel. As Doron mentioned, the standard always is to say, okay, well, how many days is Miriam spending in Israel versus the US, and allocate it as such? But there certainly are different approaches. Certainly with attorneys, I've seen, Doron can comment on this more, but I've seen different approaches because attorneys might be considered much more valuable while they're in FaceTime in the United States, if they're, depending on the nature of their law practice, but they might allocate more weight or more earnings to each day in the United States. But that's up to the Israeli accountant to work on that. But in any case, we need to come up with some sort of allocation. It is easier to now follow the money, so to speak, because she will be paid into her LLC, meaning her law firm in her New York-based law firm will pay her into her LLC. The money then, once we come up with this allocation, let's say we want to say it's $100,000 and $60,000 should move to Israel. So if she gets paid $160,000 would be invoiced from the LTD to the LLC. The LLC will now pay her Israeli corporation $60,000, leaving $40,000 in the United States. And that will be the allocation of funds in terms of how much she's saying is Israel source versus how much she's saying is US source income. Now, the nature of that income is very different. Namely, an LLC, if you own an LLC 100%, the LLC is essentially disregarded. So she will be deemed to be basically self-employed in the United States. And on that portion, she will pay income tax to the United States, and also she will pay Social Security to the United States. With the distinction being that if we say that just the monies that she left in the United States, the $40,000 for this case's example, she pays US tax on, so Israel won't be demanding during the 10-year holiday any tax on that or bituach leumi, because that's sort of out of Israel's purview. Israel's not going to see that. Israel, the United States, you'll pay self-employment tax and you'll pay income tax on the 40, and then on the 60 that you move to the Israeli corporation, that'll be that which is reported to the Israeli authorities, and Doron will go through that. So the LLC, there's no independent filing for it. It's not like you need to do a special filing for the LLC. It'll be part of his personal return, and it'll be taxed at his marginal tax rate for United States purposes. And again, he'll pay Social Security tax. The Israeli portion, I mean, let's say the $60,000 that went over to his Israeli corporation. So first of all, it's important to note that for US tax purposes, it's very sensitive to make the US authorities aware that you own assumably an Israeli corporation 100%. One of the most sensitive penalties that we've seen that the United States authorities have is someone that does not report properly their ownership of a non-US corporation on a form called a 5471. Now, the good news is, as Philip mentioned in this case, he does have an administrative assistant in Israel, so assumably he'll be paying her a salary from that $60,000. So that will be a deduction from the corporation. So he won't be paying tax on all of that $60,000. That'll be a recognized expense for the salary that he'll be paying his administrative assistant in Israel. Any other expenses that he takes in Israel as well will be deductible in Israel. Again, Doron will go through how deductions work in Israel, but I will say that for Olim, it is a little bit of a wake-up call. It is definitely an Aliyah experience to understand that Israel only allows the deduction when you actually bring an original receipt or something like that for a deduction. It's not, give us an Excel of your expenses. Doron can explain to us more, but Israel really wants to see each expense that you take in order to give you a deduction for it. But assumably you do that, you will get a deduction. For Miriam, it's important for her to separate between her U.S. expenses, which will be expenses on her LLC, meaning on her personal return. You know, she has $40,000. Let's say she has $2,000 of expenses that she incurs while she's in the United States. That will be deductible, giving her only $38,000 of taxable income in the United States. And then to keep track of her Israeli-based any income and any expenses she has in Israel, those would be deductible for her corporation, assumably, in Israel. Now, there is a tax called GILTI tax, G-I-L-T-I, on controlled corporations, on Israeli corporations that U.S. people need to worry about. But again, assuming you're paying 23% corporate tax in Israel, then you'll be okay with that. But it's an important tax to know about, especially as the corporate tax rates change. You know, speak to your U.S. CPA to make sure you're aware of them. Now, on the funds that Miriam has moved to Israel, it's important to say there's really two ways that she can take the money out of that corporation. First of all, she could give herself a salary from her Israeli corporation, and you know, as Baruch mentioned, she would get a Tofes 106. She would get a pay slip, and you know, she could have a company car. There's different deductions that she can take and benefits. She could set up something called the Karen Ishtalmut for herself. She could give herself all sorts of benefits being an employee of her Israeli corporation. Or she could leave the money in the company. Israel has a 23% corporate tax that the company would pay. And additionally, then she would take a dividend to take the money out, which would be a 30% dividend. And there could be, depending on her earnings, a 3% surtax that Doron mentioned in the last slide as well when the money came out. And lastly, if she's earning above $200,000 or $250,000 on the dividend, there could be a 3.8% Obamacare tax on the United States side on that dividend. But really, for Miriam, it's more cut clean in terms of the fact that she's going to separate her earnings for, okay, my U.S. earnings were paid into the LLC and stay in the LLC, and I'm going to pay U.S. tax on that. Again, federal, not state. She'll pay federal tax on those earnings on the LLC. She'll pay self-employment tax on the LLC. And the stuff that we're saying, whatever position Doron takes for you in Israel, the earnings there, the LLC will shift that over to the Israeli corporation, and she'll get all the expenses that she wants in Israel there, and then she'll either pay corporate and dividend tax, or she'll take it out as salary in Israel. But it's very clean in terms of how to split it up. Her law firm will pay the LLC the full amount, so they should feel comfortable with that. And that once she comes to a position with her Israeli advisor and U.S. advisor, will be able to split their earnings in U.S. and Israel as best she likes. And she will certainly be in a very good position to take the relevant deductions, that which the U.S. can deduct and that which Israel can deduct. So she really will be in a very good place once she comes up with the formula, so to speak, in terms of splitting between Israel and the U.S. She'll be in a great position to, now that she has a formula, to follow through on that, leave money in the U.S., leave money in Israel, get the relevant deductions, and take it out in Israel. Now, again, all the tax rates that Doron mentioned certainly apply in terms of Israeli tax rates. And there's certain benefits that she'll be able to take advantage of through her Israeli corporation, but it is very, very, very important to report that corporation properly, both for U.S. purposes and Israel purposes. The Israeli reporting requirements are actually quite significant, especially for no less. So it's important to connect with someone like Doron to make sure that you're taking care of all of those reporting requirements properly, because it's aliyah. You have to make sure you're covering your VAT, all the relevant things that you need to do. You're getting an audit done on your company, everything. But once you come up with that formula, it should run itself very, very, very smoothly, and it's a great scenario. So with that, I think I'll turn it over to Doron to really go through the Israeli taxation elements, both corporate and individual for our dear Miriam.
Great.
Yeah, you're up.
Okay. So first of all, Israeli corporation must register if Israeli corporation has taxable income, it must register with the tax authority VAT and Social Security, the same as the self-employed. It's a very common process that should be done very close to the date of the establishment of this company. The company will only pay salary to the employee of Miriam, but you have to allocate a part of the income to the company based on the date that Miriam spent in Israel for providing the income. So if Miriam spent in Israel about 150 days, and the rest of the time she spent in Israel, so 150 days out of 183 days should be allocated to the Israeli income. In Israel, she should pay the tax. The corporate tax should be 23%, which is flat rate. The expenses that can be deducted from the income is, of course, the salary of the employee, any vehicle expenses, any expenses that can be related to the operation of the company. The company should also register for VAT, the same of self-employed employee. And of course, because of all the income is coming from foreign sources, the VAT of the company is zero. However, the company can deduct it or can claim back the VAT on expenses she has inside the company. One other thing, dividend salary that Miriam will receive from the company is subject to a marginal tax rate up to 50%, the same as the self-employed personnel. The difference in the social security. Social security for employees is 12%, but there is an employer contribution of 4%, which gives overall a contribution to Social Security of 16% tax. Respect of LLC. LLC in Israel is considered to be a company, which means you can say that the company is like a transparent company, like in the USA, but in that case, you can pay tax in Israel less the tax that you already paid in the US. But if you make sure all the income that goes to the LLC is from the days that you spend in outside of Israel, then those income will not be taxable in Israel at all. Social Security will not impose on income from LLC. There is special rule, a special provision in the Social Security saying that if you received any income from LLC, although it's transparent entity, in Israel, the income from LLC will not be subject to Social Security, opposed to any other income, such as self-employment income or salary income. Besides that, let's see. As I said before, there is different approach. I think that if someone is conducting the job, the work in Israel for a foreign employer or foreign business, then according to the tax law in Israel, we can say that the income is not taxed in Israel. However, the conservative position says that if you are making your income and conducting your work in Israel, you have to pay the tax in Israel. In Israel, we have also something we call Chevrat Arnak, which means that if the company that you own in Israel is generating its income from only one source, from only one entity, or from entity that consists of 70% of your overall income, the income should be recorded on your personal tax income. So if Miriam decided to open a company, and the company is conducted or provide services to a U.S. entity, but the only income of the Israeli entity is from the U.S. entity, then the income should be recorded on the personal tax file of Miriam. That means that Miriam should pay 50% on the taxable income. This is a new rule that came into force in 2017, which says that practically if you are using a company to provide an income from one entity, that basically you are an employee of that entity. So that means that you need to pay tax personally, and you cannot use the entity, the company, as a blocker between you and the company. So I think that if Miriam decided to open a company in Israel and only income came from one client, then the income will be recorded in Miriam a tax return and will be subject to up to 50% tax based on the Israeli rules in Israeli tax rules.
So Ron, I think in light of the time and the questions, we're going to jump to Baruch, and then there's a few questions that are repeating themselves that I think the panel, our viewers and listeners want to hear. So Baruch, if you can just discuss briefly Miriam's case study, and then I'll throw a few of the more popular repetitive questions. Thank you, Doron.
Okay. Great, thank you, Phil. I have been trying to knock out some of those questions, so if I got to your questions, hopefully answer them properly. If not, Phil will direct them to us in a few minutes. Very briefly, in Miriam's situation, it is less clear-cut than it was in David's situation if using a PEO is the right way to go. Mainly, there's a bunch of reasons why. The most significant one is what Fred had mentioned in the beginning is you're going to have a number of expenses. In this situation, Miriam wants to hire somebody also here in Israel. It is possible for a PEO to take on both Miriam and her secretary, or whoever she's going to be hiring here in Israel, and take care of everybody for them. A PEO can handle multiple employees. You can handle up to 5 or 10 or maybe even 20, 25 employees for a company if they don't want to have a footprint here in Israel for whatever reason, although you are going to get yourself at that point. It could be something that you want to discuss further because, if you're trying to avoid a footprint here for specific reasons, you should understand the reason why. But however, there are significant restrictions in terms of some of the expenses that can be taken by individuals who are trying this approach. Fred used the example of a company car. A company car cannot, or any domestic travel really cannot be expensed here in Israel through a PEO. Most of you could technically expense some of its, some of the furniture and office office furniture, computer, some things of that nature, but there is actually a tax for that also, well, called a shovi here in Israel and some of those things, and therefore it's not really worth your while. There are a number of other expenses, I'm not going to go through all of them right now, that you're extremely limited in what you can do there, and therefore you cannot decrease your taxable base, and therefore it may be in that situation much better to go and open up your own company. You're also losing some of your individuality, some of, if you have a company that you want to brand and market some to a certain degree, the PEO is not going to get involved in your business, but do understand that all your billing has to go through the PEO. And therefore, if someone is trying to deal with your business and all of a sudden they're going to be getting a bill from or to Route 38, that may infringe on your business a little bit. So therefore, it's a little bit more tricky when opening up your own, when you have the option of opening up your own company, when you're dealing with an LLC. There also are specific issues with dealing with a personal LLC that a PEO really should stay away from. There are a number of audit red flags that kicks up. And therefore, a recommendation in that case would maybe to explore the option, but is definitely go ahead with caution, more of a yellow flag than the green flag that David had when opening up your own, having the option of opening up your own company here in Israel.
Okay, I think we are near the end, but I'm going to try to pass on. I think the most common question that is popping up, and I think all of the panelists can address it. Many people are asking, what if my employer doesn't want to put me on 1099? That I must stay on as an employee. What are the repercussions of that? Fred, maybe you want to start
Right,
that?
so it's funny. Usually we see that employers actually are nervous to keep you as an employee because it gives them some exposure to, as a company, to having nexus in Israel, meaning it gives the Israeli authorities the ability possibly to tax the corporation because they now have an employee in a foreign country, in Israel. That being said, if they want you as an employee, we have no problem with it whatsoever. Again, as I mentioned in I think in David's scenario, they will be contributing to half of Social Security, while half of it you will be. The downside here is, though, on the portion that we say is Israel taxes first, you're going to have to pay bituach leumi on that portion, regardless of the fact that, again, you pay Social Security on it because it was withheld at source on your portion. But there's no issue in terms of sourcing. We're totally able to source that which we feel is Israel to Israel, and that which we're going to leave in U.S. If you stay as an employee of the company, we're fine with that. You're going to actually conceptually save on some of the self-employment tax because your employer is now contributing it. So that's all good. The only thing you should really be speaking to them is about the withholding aspect of it, because you don't want them to withhold on the full amount if you're really going to be paying Israeli tax on a sizable portion of that, because then you'll have a cash flow issue until when you pay Israeli tax, if you didn't get a refund yet on the withholding on the U.S. side. That, and just make sure they don't withhold state taxes. Those are the only issues with staying on the payroll. But there's no problem with staying on the payroll. It's just a question of, the biggest issue I've seen is someone that says, I'm going to stay on the payroll, but I'm going to be in Israel full time. If they can't deal with the withholding, they could get into a cash flow crunch in terms of until they get back their U.S. withholding. But there's no problem with it, and there actually is a benefit on the employer contribution of Social Security piece of it.
Baruch, with regard to this question, have you ever been able to advocate for people who are in this situation, meaning help convince
specifically people who are usually continuing as W-2s? There's not really room for us, unfortunately, in that equation, because we do need to have a direct relationship with the end user client, with the employer, the ex-employer in the States or whatever country it's going to be in. And generally speaking, if there's a W-2 relationship, that direct relationship is going to be continuing between the employee and the employer. I did just want to add, and maybe I'm wrong, but and maybe Fred and Doron can opine about this, but when you do stay as a W-2 here in Israel, while it's fine and dandy, the U.S. company is required to open some form of it's called a tik nukuim, I believe, some form of a payroll tax file here in Israel. It's a very limited file, but it does require them, if that's the case, and please correct me if I'm wrong, if that's the case, most companies, most foreign companies do not want to have any nexus here in Israel whatsoever. They don't want to have any foreign country have anything to do with them whatsoever, and they're very nervous about opening up a foreign tax file for whatever reason. And that's generally something that keeps foreign companies such as U.S. companies, Canadian companies, whatever, from opening up any type of nexus here and any tax file here.
Meaning, I think I agree. We don't see very often cases where the company wants to keep them as an employee. It is interesting that that's the question. Usually, the employee sometimes wants to keep the benefits, such as the 401k, whatever the other benefits there are of being an employee, the employer's contribution to Social Security. The other way around, where the employer says, "I want you to stay as an employee for their purposes," as Baruch is saying, actually opens up some exposures to Israel that I'm sure Doron could say in terms of it does give some, besides the nikuyim, the withholding, whatever it is, it also does expose them possibly to Israeli taxation as a corporation having an employee here. So it's very rare that an employer would insist that you stay as an employee, but it actually would probably give you more benefit than anything else for the employee's perspective.
Okay, Doron, I think this will probably be the time for our last question, although we did manage to answer 43 questions on the fly. But Doron, could you just mention to the listeners about how Israel taxes married couples, that as opposed to the U.S. where their income is combined, how married couples are taxed in Israel?
You're saying about married couple who is living in different places or living together?
They're both living in Israel.
If they're both living in Israel, so if they have let's say unrelated income, so each one of them pays the tax separately. I'm talking about not the passive income. I'm not talking about the dividend or rental income, but I'm talking about the salary or the self-employed income. Each one of them pays the tax separately, but the tax return is submitted together. There are two columns in the tax return: one for the husband, one for the house. For the wives, and each one of them paid the tax separately, given that their income is not related to each other,
Right, and just to comment, a working mother, let's say, with 3 or 4 children, how does she?
Okay, working mother with 3 or 4 children received it's called credit points, which give her tax saving of about 3,000 shekel every year for one child. Okay, so that means that if she should pay about 20,000 shekel a year of taxes, and she has 3 children, she get an deduction or a credit of 9,000 shekel that is computed based on the number of child multiplied by the value of the credit point. The credit point currently is about more or less 3,000 shekel a year. That gives us a tax saving of 3,000 a year for each child.
Okay, thank you. Josh, I think we've used up our allotted time.
Yes, I think we have. We've hit an hour. Thank you all for being with us. I want to thank our panelists who tried to cover an immense amount of information in a fairly limited amount of time. We will be sharing this recording. We will also be sharing the presentation and contact information for all our panelists. If you do have questions, I have shared the email addresses of the 4 panelists here in the chat, and you will be receiving them additionally in the email we send out with the recording of this session. All are available and perfectly capable and ready to answer your questions individually. Please direct your questions, anything you weren't able to answer directly to them at their respective email addresses. Thank you very much and have a wonderful evening.